Bahram, it's always a pleasure to talk to you on regulation and everything else, and especially with respect to the private credit industry. Now, the one big issue that this industry will face, maybe or maybe not, is the advent of the RBI's regulation on acquisition financing. It's pretty much, this whole world was about the space where there was this capital market regulator and capital market related activity sitting on the one side, and the RBI regulated loan origination type business on the other side. And suddenly RBI comes and says, hey presto, you can also do acquisition financing. How do you see this? Do you see this as a threat? Do you see this as, how do you see that impacting?
No, thanks a lot. So I think maybe you guys tell us whenever you want us to stop, because Abizer was also telling me, are we really doing this now? Everyone must have had a long day. So please, jokes aside, whenever you feel it's enough, just let us know.
Yeah.
So I think that, what happened was it almost became where everyone except the Indian banks could participate. So the chairman, SBI, in an open forum where the governor of RBI was also there, said that this is really not fair. The reasons for not allowing were decades old. They did not hold good in today's times. And I think on the spot, the governor said that makes sense. I'll look into it, and a few weeks later, it opened up. So it was more that they were the last bunch not allowed to participate. So that's how it happened.
But I must say that if you look at it, I mean, most people here may appreciate it. If you look at the sheer size of the decision, it's quite large. If you look at the whole private credit market, which includes performing credit, special sits, as well as the whole real private credit market that exists in India, and this is onshore only. I'm not talking about the offshore market. The onshore market is roughly 2 lakh crores, $12 billion or so, whatever. And if you look at the total tier 1 capital of the banks in India is 30 lakh crores. And they are allowed to lend up to 10% of the tier 1 capital, which basically means that potentially if they came into the acquisition market, they're going to have a 3 lakh crore kitty. And which also means that they're going to be able to fund 4 lakh crores of Indian acquisitions, because they can fund, they need only 25% capital. So, we're talking about a banking industry which will end up becoming as big as the current AUM of the private credit industry. So as a business, I think there is some need to worry about the fact, because banks will come rather naively, but they will come with a cheaper balance sheet, so to say, a cheaper cost of funds. Is that likely to create some element of issue? I do concede to the fact that if you look at the private credit industry today, they have not lent too much to acquisitions. So that's the good part. But do you otherwise see an issue to this?
Yeah, so I mean, that's a great point. I don't think many have gone into the detail that you have gone into. It pretty much washes out the entire current market. But a couple of things. One is, I think we need the market to grow as it has been growing.
Oh,
so
yeah.
I was told this year we are hoping the 12 billion becomes 15 billion. And as you well know, globally, if you look at the private credit re-India, it must be at least ballpark 3 times.
Oh, absolutely.
So say it's about 36 there, 12 round figures, about 50 billion. And as we both know, in 2016, it was virtually zero.
Yep.
So we have gone from 0 to 50 billion is not bad at all.
And fundamentally, if we have to be at least 5 times the size of a private equity market,
Yeah.
if you take a leverage of 1:5, including that of the banking sector. But I think to some extent, what we were missing in the private credit market, which they actually got is actually part of that cap structure. So the cap structure comprises of many things. And maybe banks play a role because they are kind of responsible finance in that sense, because they are public deposits. But there are various categories on a cap table. There's equity, then there's structured debt. I'm talking in inverse proportion of risk. There's structured debt, then there is performing credit, and then there is bank credit. So clearly bank credit is the least riskier among the two, for a reason, I guess. Would you have a view on that?
Yeah, no, I'm fully with you. But I mean, the key reason being that it's public depositors' money. So obviously their DNA is going to be much more conservative. But again, just to end on the super point that you made, as we well know, globally, the private credit market is in the trillions of dollars. So India so far has been super focused on private equity, and we have done fantastic with private equity. I mean, both domestic and foreign, your who's who, Warburg, KKR, TPG, blah, 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 and fantastic domestic PE firms as well. Credit, we came to the party way late. So a bit like our equity, public markets, equity, I truly believe we are world class. Second to none. The debt markets, you and me both have been hearing for at least 20 years how we have to deepen the bond market. Very slow progress is my personal view, but it's getting a little better. Private credit, actually, I see the curve, I'm biased, but I see the curve has been much steeper.
So I think once the regulation opens up, like you see what happened to the GSEC market, by the way. It was for the last 2 years 5,000 crores. This year 41,000 crores. Actually coming into the GSEC market just because they gave the tax concessions. And they exempted the capital gains tax. And I think frankly capital gains tax exemption seems to be the mobilizer of capital for this country. Look at the equity markets. And very frankly now you look at the debt market, the GSEC market. And very frankly if they give more and more ability to fund private credit or even bank credit, well, bank credit will be taxed, but private credit through more and more, say, capex. India's capital formation, for example, can happen very well through the private credit markets.
Absolutely.
Because it requires flexible capital, and a banking system, though will not give flexible capital because, very frankly, they need, as you rightly said, the depositor base is very different.
That's not their DNA.
Yeah, that's not their DNA.
So it's not fair on them also. So India needs both. I mean, that's the point you're making, and we definitely need that. Tax is a huge driver, there's no doubt. I mean, it's not exactly tax, but I know you're not, I get the feeling you're not very happy about it. But the FCNRB,
yes,
again, which is going to bring in tons of money,
yeah,
but we are eating the forex risk.
Correct.
Basically, the government is subsidizing. So anything like that will bring in tons of capital. But
yeah, you're right. But the way I look at it, Bahram, also is that to an extent, when these situations where we are against the back of the wall happen, like FCNR, for example, I think what we'll see is a gush of capital coming in. And if you are able to deploy that capital well, I think we'll create a precedent. For example, I do think that GSECs will create a precedent to say, why not the corporate bond market? And then you can have a lot of funds coming in through the corporate bond market route. And that will, of course, not be private credit, it will be public credit, but it will actually come into the markets in that route. And I think more and more private credit will actually graduate into public credit, and I will tell you why. So for example, you start off with a private credit type situation. At the end of the day, you would have lent to a company which has a good credit risk and will move to some extent. But when that credit tends to see a trying time, you may need to convert that private credit into a public credit, i.e. a listed instrument, for obvious reasons of SARFAESI. And I want to kind of segue into this whole SARFAESI element to say, how does this really work? Because for a listed entity, they can do it. And I wonder what kind of, recovery recourse that private credit would have.
Yeah, I mean, that is definitely one of those non-level playing fields. And but the ethos is the same, that because you're listed, it's public money, and the regulator wants to protect public money, and therefore you're allowed to use SARFAESI. But as both of you know, both of us know, the goal should be to have a level playing field between domestic and international, but then also tax-wise.
Absolutely, everywhere.
I think maybe you can spell out, as you are the tax guru, that it's not a level playing field for domestic and foreign. Foreign has a substantial advantage on the tax part, So that should be
On the distressed asset side, and just for the rest of the group, really, and I think this issue has been raised. Srini was there early in the morning, and he's kind of a champion of this issue. But I'll just state it again. The real issue is that domestic funds, if they invest in SRs of ARCs, they don't get the pass-through tax benefit. They actually get taxed as business income. But foreign funds,
business income, so a very high
rate of tax. Foreign funds, if they are investing in SRs of ARCs, they actually get pass-through taxation, which basically makes a huge difference and makes domestic funds that much more incompetitive. And that really, I think the both ends of the level playing field need to be sorted out, because capital has to move freely. When capital cannot move freely, very frankly, I don't know how you will even right price any kind of capital. So you'll have banks which will, in my opinion, do very cautious kind of credit. Though they may have the ability of pricing it cheaper because the cost of funds is cheaper, I don't think they'll be cost of fund driven. They shouldn't be. Well, SBI, for example, I know for a fact that chairman has gone on record to say that I will come in a very graduated manner in acquisition financing. Though, as you rightly said, he was the champion of the whole cause. But he will do it along with somebody in a syndicated fashion where he understands how to price the risk there. If he says, I'm going to price off my deposit rate, then there's no business for any of us. But very clearly, if they price it off the risk that is being taken on a risk-reward basis, then frankly it's different.
That's the right way to go. I mean, it's someone who is doing it sensibly. It's no use pretending you know something which you haven't done. So it's a perfect way to go. So another question before you ask me that, and it's a very tough one. So, this inter-regulator issue, that now we are in a market where there are two regulators. For half of the players, it's RBI, and for another bunch of players, it's SEBI. So, what would you, in an ideal world, how would you like to see this when you're talking about level playing field? How would you like to see this evolve?
Very frankly, this whole distinction between a debenture and a loan is unnecessary in that sense. And hence that applies to ARCs and everything else, because if you look at it, I mean, why should a debenture holder, unlisted debenture holder that is, have the same recourse and the same tools that a bank has? Even the loan is not listed, just by the way. So ideally, how do you make sure that the public depositor custodian, which is RBI, and in a way an investor custodian, which is SEBI, they're literally achieving the same objective. And what we will find over time is that capital flows, whether it is, we saw a whole flow of SIPs into the equity markets. We're now seeing a reverse flow back into the banking market. We're seeing a lot more flows into the debenture markets, directly listed and unlisted debentures. So ideally, should all these be treated by a similar regulator? I think the SEC model that way is a perfect model, where there is the Fed, of course, but the Fed is monetary policy driven more so, but securities and loans are interchangeable. And I think if we can work that out, if we are able to deal with the regulatory turfs. So for example, there was a move, I remember, by SEBI to say we should have distressed loan funds. And they came out with regulation around having distressed loan funds. So SEBI can get loans. But RBI put it down, saying, no, if it is the word loans, then I am responsible for it. If it's the word debentures, then maybe you are responsible for it. I think somewhere the borrower, more than the lender, the borrower will see the slip in the crack. So for example, let me give you an example that's happened practically. If somebody has a loan in his books of say 100 rupees, and that loan for some reason goes into default and the fair pricing of the loan is say 50 rupees. Sustainable debt in the book is 50 rupees. If a private credit person wants to come and invest, he'll have to fund a debenture today. Now, very clearly, the borrower will have a right to say whether this loan should be converted to a debenture or no. He will not allow a conversion. What he will insist on is a refinancing of a loan by a debenture at a value. So what happens with that is, the benefit of the 50 rupees, so to say, reduction in debt goes to the company. Unless, of course, the private credit person comes through an ARC and buys out the loan. That's the only way he can today retain that benefit. Otherwise, interchangeability of a securities instrument and a loan instrument doesn't exist. And the arbitrage sometimes may go either to the borrower or sometimes even to the ARC. What is really required is to disintermediate that stuff and say how we can actually replace a debenture with that of a loan. And I think the day we achieve that through regulatory confluence is, I think, when the markets will flow and discover the right pricing. Because when a bank, for example, decides that it's not a good credit for them and hopefully the banks will mature over time, to say that let me sell off a loan to a distressed asset fund. And they could actually sell it off to an AIF as long as he's able to fund it with a debenture. Then that will be good. Today the ARC intermediary is absolutely a necessity, which is not there anywhere else. Anywhere else you could do it. So I guess if we are able to reach that level, Bahram, I think we'll have a free flow of markets and the credit will mature faster and right pricing will happen.
No, I agree with you. But I think that's a very tough one.
But what is the regulatory think you think between SEBI and Vakil? You're more close to the regulator than I am. They kind of shoo me away quite a bit because of the way I speak. But what do you think is the regulator think? Because that's important to understand. I'm sure they have a logic behind it.
I think that what you are saying, though it makes very good sense, extremely difficult in India. I think for RBI to let go of a loan product is very difficult.
Not let go. Co-govern.
But co-govern how?
I think
you already have...
We already have the regulator sitting on top of SEBI and RBI. And maybe SEBI can be a subset of RBI. That's fair enough.
Yeah, something like that. Something like that might work. But otherwise saying, following the SEC and saying that you treat a loan and security analogous and put it under SEBI's...
No, you can't put it under SEBI's.
That will be difficult, yeah.
I think we'll have to make RBI as the top regulator with SEBI, IRD, etc. as... today there was this thing where RBI was at the top in financial stability and we had created that structure, right?
Yes.
There was the structure created, right? Where RBI did not have kind of absolute leadership over the others, but I think it was kind of first among the equals.
It is, yes. So, but I think the key thing is, as a country, the mindset that, both are equally important, equity and credit. The fact that actually Delhi figures out that inevitably equity is more expensive than credit. So there is so much tax disadvantage also to credit over equity. I'm not clear where the government is coming. If you could have a level playing field for credit and equity, because we need that money, just between infrastructure and now AI and clean energy and all that stuff, we need that money, and a lot of that money has to be also credit, because infra, as you know, is 3-to-1 is a standard leverage. So, and we certainly, one of the key objectives of IBC also was to get away from this dominance of bank credit. We leaned on banks and public sector banks in particular too heavily. 84% of the credit was through banks. So if you want, today we are far from that, and if we want to really create the capital that India needs, we have to, have a different mindset.
Oh, very clear. And I think everybody has a role to play. As I said, we explained the cap structure earlier. I think if you look at the private credit business, the flexibility, the ability to give flexible credit will go a long way, one, in terms of resurrecting organizations. And Bahram, you may agree that, every 3 years now we are facing some calamity or the other. Right after COVID, every 3 to 4 years we are seeing something or the other happening. And that resets businesses. COVID reset businesses. But imagine that if we had a mature private credit market at the time of COVID, imagine the kind of funding that could have happened to our retail enterprises, our airlines, where flexible credit could have come in, which would have given money upfront with an ability to back end the interest, structure some kind of an equity upside, and actually convert this whole IRR game into something really different. And I think that market is maturing. So maybe when the next cycle comes, our private credit will see much more opportunity because of flexible credit.
Yeah, I'm quite sure. And also, I mean, I can't not say something about IBC. So, the new amendments, the pre-pack, I mean, if there was a pre-pack, imagine where Jet Airways would have been
Oh,
today.
absolutely.
I mean, only Suharsh is happy that Jet Airways is still going on, but other than that, I think we'll, give our poor audience a break. We can always continue. Any questions, or otherwise we can.
Yeah. Sure, there's a question. Is there a mic or something?
Thank you, Bahram sir, Abizer sir. So, what you were describing about an AIF coming into acquire distressed assets, that's a dilemma that we are also facing. So, sir, apart from I would say that what you've talked about, it's the longevity of my being married to the asset also. Most of the assets we are looking at a fix and flip kind of an exit. Okay. Now, if the fix has happened, say after 12 months of say acquiring that property, I am still married to the asset for 2 years or 3 years, depending on whether I have invested through a equity route, unlisted equity route, or an unlisted NCD route. Otherwise, who will face the brunt? My LP, because AIF 2 is passed through, so he will have to pay STCG if at all I dispose of the asset, if at all it's an unlisted equity within 2 years, and within 3 years if it's an unlisted debenture. So, sirs, with your collective experience, is government doing something about that, probably to shorten that particular thing, or maybe to adjust that particular marriage time for a faster exit? It's a very selfish question I'm asking from my own perspective.
It increases your tax rate. So if you're talking about domestic AIFs, you're talking about domestic AIFs.
Yes.
And domestic AIFs, clearly there is a case to have a level playing field from a pass-through versus a long-term or short-term capital gains tax. That I agree with you. But fundamentally to say that, I should encourage fix and flips, I think that's not the intent of private credit. The intent of private credit is you need to do larger resolutions. And I emphasize on the word resolutions rather than recoveries. Yeah. Because if you are stepping into the shoes of a bank which is used to giving normal credit and saying, let me take over a credit and create employment, resource optimization, etc., which is an objective of an IBC, then 2 years of, fix and flip is not going to work.
So that the business can continue. Yes.
I agree. So if you put other benefits, and I think those are highlighted, then the tax benefit may fairly be justified. So I think if it's a 3 to 4 year or 5 year, I'm actually doing a company right now, and we have a 4-year turnaround plan, where we are going to retain 200 employees. So if we are going to create livelihood for 200 employees, enhance production, which will contribute to GDP, and then if I go ahead and says I can go tax break, yes. But then you will fall within the long-term bracket anyway.
Yes, correct.
Yeah, I think totally agree. Because the mindset of the regulator and government is not short-term. The idea is to...
Right, if no further questions. Sorry. Listed debentures. No, so the thing is that listed debentures entitle you to SARFACI. SARFACI is the ability to possess assets. So if you are a private credit fund which has an unlisted debenture as a structure that you may have issued, and say at the underlying they gave you a security which is a piece of land, I'm just making it up. Because you are an unlisted debenture, SARFACI does not apply to you. And hence you cannot utilize SARFACI to do recoveries. And unless the recovery matter is clear, how would you be able to invest in an asset? However, if that same asset, same debenture was listed, then you could do repossession of land under IBC, under SARFACI. So that was the issue. Now, what happens is normally, say there's bank credit. Second point that I was explaining, there's bank credit. And if the bank credit has to be refinanced at a right price by an AIF, the AIF can only issue debentures. Now, ideally, what would I want? I would want that first the loan is converted to debenture, then I buy those debentures at a price. Then what happens is the obligation to the company remains at 100, as the example I gave. Fair value of the debenture is 50. I am buying debentures worth 100 rupees at 50 rupees with the hope that I will make a long tail collection. But that requires the borrower to consent to conversion of a loan into a debenture structure, which he will never do. He'll extract his pound of flesh. And if you're doing it, the 50 rupee benefit should flow to the company. Hence, there is no long tail. To do this transaction, we necessarily have to go through an ARC. Otherwise, you can't do it.
What is ARC? AIF, I wouldn't know. ARC would be?
Asset Reconstruction Company. A different concept altogether. Sorry, any other?
But you know, the key thing here is that from both a reputation point of view as a credit risk country, the faster the enforcement, in fact, my partner Anand made this point in the last panel, if enforcement is longer and more painful, it will be priced in. So that means it becomes more expensive. It's a lose-lose. It's bad for the borrower and it's bad in a general environment sense, because then the perception everywhere is, oh, enforcing in India is very tough, which actually I do not believe is the case anymore if you have used the right lawyers.
There's some set of lawyers who are saying that while the debenture holders don't have SARFAESI rights, but because you have a trustee in place, the trustee can actually go ahead and do SARFAESI. Is that a view that you agree with, or that's not something?
Only listed. Only listed.
Only listed.
A debenture trustee by itself is not covered on the surface. But listed entity, debenture trustee is covered.
Is listed.
I mean, anyways, where debenture, only the debenture trustee has to enforce.
Yeah.
Right, gentlemen, thank you.
Thank you. Thanks
Thank
a
you for our
million.
time.